Welcome back guys to another Zero DTE video, and today Ernie's going to be talking about staying profitable in a flat market, so make sure you stay tuned. If you're interested in becoming a pro trader, check out the link in the description where you can find Ernie's education platform. Enjoy guys.
There's a 1 hour chart. It's very useful, I think, because it gives you a very quick view of how the market moves, what your expectation should be in this market, which is pretty low. Now, it was much better, actually, in the late summer and early fall. There were many more occurrences, but recently that just hasn't been the case by a long shot, unfortunately. And the market has just been going basically straight up with little movement intraday, or movements that start out strong and then end up right back where they started. For all these reasons is why I've been telling you that you should trade much smaller and take less risk, have lower expectations, be quicker to take those small profits. It's just a reality of the situation. Now, it was similar to this. If you look at my trade log that I publish, it was very similar to that from the 12th day to the 70th day. It was very similar. And I went sideways for that entire time. For 50 something days, I went sideways without making any significant advance or drawdown. But that was because we were in super low volatility. I dropped my position size. I squeezed down the width of my flies and just exposed myself to the market far less and took quick profits. And that seemed to work out, kept me level until things started to break out again. So now I'm thinking that we can probably modify that a little bit. I think it's still important that you reduce your position size on average, but I'm not so sure that we have to reduce our trade width that much. Maybe we stay 15 to 30 instead of 10 to 20. But just push it much further out of the market so that the cost is less. I started looking at this over a long time, but you have to now have clear expectations on what that's going to mean. It's going to mean that you're just not going to get into the profit tent all that often. Your win rate's going to go down, but your return is actually going to go up. But that appears to be the case. It appears that seems to be like a good move. Just push it further out of the market, maintain the width, keep the costs down, and go from there. I mean, it's still basically the same philosophy. We're still reducing our size, reducing our overall exposure. We're just adjusting a little bit. Instead of staying right around 1 to 9, 1 to 10, push it further out. That will allow you to maybe go to a slightly wider thing. The reason why you do that and maintain maybe a slightly wider fly is that it reduces your gamma risk now. So now the wider you can go with a fly, the flatter your premium curve will be. And so I'm seeing that as a way to improve our chances of making profits without increasing our risk.
Thanks for watching guys. I hope you enjoyed the video, and if you did, make sure you hit that subscribe button and hit the like button below. If there's any questions that you might have for Coach Ernie, make sure you leave them in the comment section. Thanks guys.